All right, we're going to do the last chapter here, which is 22, and it deals with investing. As a real estate investor, and I made a living for a number of years doing this, I'm kind of disappointed that this chapter, to me, could have been as big as this entire book. But it's not. Alas, it is not.
It's the shortest one.
So, dealing with real estate is a popular investment, and typically, whenever the overall market is down, the real estate the investing portion is still up. All right. So there's a lot of people that can make money: the developers, the landlords. You've heard the term flippers. It's not a big favorite term of mine. Wholesalers and all that. But you have to stay current with the up-to-date real estate. That's why I suggest all of my clients that were ever investors that I helped or worked with, I always advocated, hey, you should probably go get your license. Even if you never become a RE/MAX agent or a Century, you have at least got the knowledge that you can use that will help you when you understand, geez, do I want a general warranty deed or a special warranty deed? Or I bought that house with a quitclaim deed. Oh, you're screwed, really? Because I don't know what that means. So you want to get the information. So there's some definite advantages and disadvantages in real estate. We'll talk about the investing portion. We're going to talk about some financial concepts and a couple of the, I don't want to use the word schemes, but techniques. Here we use this thing called pyramiding, which is really not a scheme. It's not like a pyramid scheme, but there is a technique called pyramiding that we'll talk about, as well as leverage, where you use somebody else's money. We're going to differentiate between the tax advantages between owning a home and being an investor, and there's definite different advantages. So mainly there on the screen, you can see that there are some advantages to owning or investing in real estate. Generally, real estate investing gives you an above average rate of return. It's not uncommon to get 10, 12, 13%, where if you go to a bank, you may get 1% or 2% on your CD. You get the leverage. That's my number one thing. Leverage is the use of opium, right? OPM, other people's money. Maybe I said it wrong a little bit. Leverage is when you use someone else's money. Think about this. I'm going to buy an asset. I'm going to use someone else's money to buy it, i.e. the bank. I'm going to put a tenant in it and let that tenant pay off that asset to the other person, and I'm getting credit for every time they make a payment.
And hopefully making money.
Yeah. So, I mean, that's sweet. Someone else's money to buy an asset, and I'm having a third person pay it off, and I get all the credit for it in the form of mortgage buy down, cash flow, tax incentives, all of that. So there is no other better place to make money than in the real estate investing world. Plus, you also have greater control. I mean, you own rental property. You decide today it wants to be blue, go down and paint it blue. You can't do that with your Chrysler stock. You don't have a decision, well, I want Chrysler to start doing this. No, there's many other owners out there. Now, what's the disadvantage? Obviously, the disadvantage is a share of Chrysler today was like 16 bucks. You're not going to buy an investment property for 16 bucks. So there's some more cost involved in the actual entry cost, and the barrier to entry is a little higher. The number one disadvantage to me is liquidity. I know people that are millionaires basically on paper, but can't afford to buy lunch today. So that's the problem. You got Chrysler stock, I call my broker and say, sell it. Before I hang up the phone, it's gone. I've owned rental property before for a number of years that I didn't want to own. I just couldn't get rid of it because the market was upside down, or it was in a tougher neighborhood, or when I first started, I paid too much for the property. So liquidity is the number one thing. Even if I could sell you the property today, give me 10 bucks. You're going to want to run title work on it. That may take 3 days to get the title work. Well, 3 days is not long, right? Well, what if I need that 10 bucks for lunch today? So liquidity is a problem. Obviously, the management is probably one of the other issues because you have to actively manage. And there is obviously a greater degree of risk that comes in that. So let's talk about the investment as a whole. Sometimes you hear it called an income property, and we're just talking generically here, whether residential or commercial, doesn't matter. The first thing, or one of the great ways to make money, is this thing called appreciation. Appreciation is the rise in the value for whatever reason. Now, you also have to worry about the cost of living going up as well. That's called inflation, right? So you want your house to appreciate faster than inflation does, so you make a profit. If your house only appreciates 3% and the inflation goes up 3%, you didn't gain any money. Inflation goes up 3%, your house gains 5% in value, now you're making money. So that's what we got to talk about. So that's just one way to make money. Just to remind you, and like Christy just said, it's getting to the point where you guys should now know about every term we've talked about. When it comes to land, you can't depreciate the raw portion of the land. Unimproved property, you cannot depreciate it. Hence the land lease or the sale lease back that we've talked about. Cash flow is one type of income. Back a couple chapters ago, we had those equations. You had the net operating income, you subtracted your debt service to get cash flow. Can cash flow be negative on a property?
Sure.
Sure. In the investment world, we call that an alligator because it's biting your butt every month. All right? And that comes from the fact that your debt service is probably higher than your net income. Right? And how do we give the property value? We use the net income and the cap rate. So theoretically, think about this. I can have a property that has a net income that's good, use the cap rate and show you a value of the property, and you go, oh look, that property's valued at $2 million. Buy it, and your cash flow will be negative because your debt service is too high. All right, so it's possible to have a negative cash flow. Is it ever recommended? I actually know a couple of guys that bought a property knowing it was cash flow negative, but they were, what's the word, speculating that the appreciation would be so tremendous that they would gain all of that back. It was Florida.
It was the what was so?
The appreciation was so tremendous in a short time period that they actually paid monthly payments because the negative cash flow was negative cash flow, but when they sold it, they made like 2.5 times what they paid for the property, which negated all their monthly negatives out. So in the long run, they made money, but they still every month paid, here we got to pay this month, this month, this month, and then when we sold it, we made money.
That was the big news story Tuesday morning in Florida was the housing market.
Yeah.
I mean, things are on the market for less than a week and they're going for full price and people, I mean, it's.
Did they not learn?
I know.
At some point, you can't blame the wolf all the time. It's the dumbass sheep that just keep going out in the field, hey. Oh well. So let's talk about leverage. To me, leverage is the #1 ability. Where else in the world can you leverage $10 with $1? That's a 10% loan. You can in the real estate world. Used to be a couple years ago, I bought several properties with no money down. So you're leveraging $10 with nothing. That's a damn good trick. So OPM is other people's money. That's what, in the residential world, when you're a homeowner, we talk about it being a loan to value. And we say it's 80% loan to value. In the in the investing world, they love this word. Oh, I'm 80% leveraged, which is the same thing. I've got a loan that's 80% of the value. So you'll hear that in the investment world. Instead of saying I have an 80% loan to value, they'll say I'm 80% leveraged on this property. Or the other term is fully leveraged. What does that mean? 100%, no equity. When someone says I'm fully leveraged at the moment, I don't have enough money for the capital injection because of my debt service is way too high. Really? So what you're telling me is you're broke. Because your mortgage payment and you have no down payment. Yes, exactly. But it sounded so much better when you said it that way. I always love it. When, next time someone tells you, hey, how you doing today? Tell them, oh, I'm not unwell. Because that makes people think, I'm like, crap, what's that mean? He's not unwell. You will also hear the term equity buildup. Every time, remember back to the amortized loan, and I told you that each payment has a portion of principal and each portion of interest. Every time you make a payment, remember that amount of principal got bigger. You're building equity every time that you make a payment. They call that equity buildup. That's for the positive people. For the negative people, sometimes you've heard people called mortgage buy down. Yeah. Is the glass half full or half empty? I don't know. While they were arguing, the opportunist drank it. Now, there is another term that we mentioned that is very common, is to do this thing called pyramiding. Pyramiding is when you suck the equity out of a property and you use it as the down payment for the next property. And then you take property number 2, you create some equity in it, suck the equity out, and go to property number 3. This is a very common technique. Now I will tell you, this is a much easier technique in the commercial world because I can change the value of a property overnight, right? Remember, because it's based on the income it generates. So if I suck the equity out, I can go buy a vacant office building or a strip center, fill it up, earn equity, take the equity on that one, and go buy another one. There are 2 ways the book talks about pyramiding. I will tell you, in the investment world, only one of these is really what we call. There's one called pyramiding via refinance or through refinance. That's the true pyramiding because I'm keeping the property. I still own property number 1. I have put property number 2 on top of it, and then property number 3 on top of it. The book also mentions this thing called pyramiding through sale. That's just a sale and a buy and sell. Yeah. I don't see how that's truly pyramiding unless you're just getting a bigger property. I will tell you that most of them say that pyramiding through refinance is true pyramiding. Now, investing in real estate also brings about some great tax advantages, and let's talk about them. The first one is the depreciation. Remember, we have calculated depreciation before. It's a straight line depreciation. And if it's an investment property, let's do this. Let's say this property's got an economic life of 30 years and it's worth $300,000. In 5 years from now, how much is the house worth?
In 5?
250,000.
Very good. In 5 years, how much is the house worth? If it's got an economic life of 30 years and it's valued at 300 grand, and that's just the structure, not the land, what's the depreciation rate? 10,000 a year. So in 5 years, that would depreciate 50 grand. It's now worth $250,000. That depreciation of 5K, here's where it's really beneficial. Suppose, how much did you just say, Leslie, it depreciated a year?
10,000.
10,000. But let's say I rented that property out for $800 a month. How much income did I make? 8 times 12 is 9,600. That's less than the depreciation. I don't report any of that income as income. It gets offset by the 10,000. So I collected $9,600, but I didn't pay taxes on it because of my depreciation. So that's where the depreciation helps you, quote unquote, finger quotes, hide income.
So really, it's not beneficial to own a house for more than 30 years.
There's a lot of techniques where you can draw that curve and not, it's called the ACRS, the accelerated cost recovery, and the curve turns out to be curved, and where it crosses the line, it tells you what year to sell the property.
Oh, really?
Yeah. If you get really into like the CCIM and the commercial like Simon does and all that,
Yeah.
they can figure out what year we need to sell this
Yeah.
property. Because we've sucked all the depreciation out, and from here on out, we're now upside down and yada, yada, yada. And you can do that because remember I told you you have an economic life of everything? Under the straight line, they just say a house is 20, let's say a commercial building's 27 and a half years. Well, that's if you look at it as one building. You could actually go in and say, well, that building's actually a roof, and it has an economic life of 15 years. So you get a curve that looks like this. And the parking lot's 17 years, got a curve that looks like this. And the carpet's this. And what you end up getting is a curved acceleration, and it's called the ACRS, the Advanced Cost Recovery. And then where those two lines meet, whatever year that is, it'll tell you when to get out. All right?
Is this when you talk about the 1031 exchange?
Here we go.
Okay, good.
Get right now. We're not probably going to go into it as depth as you wanted to because you're an investor. But remember the rule that said on the first $250,000 if I'm single, I don't pay taxes on it?
Right.
If I live there 24 out of 50 months, 24 out of 60 months, and that's what defined owner occupied, that 24 out of 60 months. If you don't live there, it is considered investment property. You pay taxes on every dollar. You make a dollar profit, you split it with your partner. You know who your partner is? Uncle Sam. All right? You pay money on what they call capital gains. A capital gains, for lack of a better word, in this class is just going to be profit. All right? And capital gains is defined as your sales price minus your basis, or your adjusted basis. Your adjusted basis is what you paid for the property. Okay, we've now got another value. Every time we've done something, we've used a different value, and I've told you that. For taxes, we use the assessed value. For loan origination, we use the loan amount. They also could use the loan for the appraised value to generate the loan. When you're dealing with your capital gains, it's now actually what you paid for the house. Doesn't matter what the loan amount was, doesn't matter what it's assessed for, it's what I paid for it. So let me do you a really quick, easy example, real life example, by the way, that will help you. I bought a double for $50,000. I put $10,000 of repair into it, putting a new roof on. So there's the purchase price plus rehab is 10 grand. So how much am I into this property? 60,000. I turned around and sold it for 100.
You pay capital gains on 40.
So how much was my profit? $40,000. I would pay capital gains on that property. And capital gains is treated just like ordinary income. It's no different than if I went out to McDonald's and got a job flipping hamburgers and made $40,000. Now, capital gains, there are two types. They're short and long. Short-term capital gains means I did it in less than a year. That's how it's treated like ordinary income. Long-term capital gains currently right now is 15%. So if I held the property for longer than 1 year, it would be a long-term capital gain when I sold it. No matter what my ordinary income tax rate is, I'm only paying 15% currently under this presidential administration, which could change. Slick Willie had it at 40. All right. So, how can I avoid paying capital gains on this property? I can do what they call a 1031 tax deferred exchange. It's called 1031 because that is the IRS code for this. To actually have this happen, I have to exchange like-kind properties. Like-kind. So, can I trade my double for Simon's Greenwood Mall?
No.
The answer is I most certainly can. Because the IRS considers those both investment grade properties. That's what like-kind means. Not strip center for strip center or apartment for apartment. I can transfer my double for the Greenwood Mall. Now it's up to me to come up with the difference in cash and equivalents and all that, but the IRS says they're still investment grade. I can't trade my rental property for your airplane. One's personal property, one's investment real estate. I can't trade my rental property for a house I want to move into in Florida. One's owner occupied, one's investment. That's what they mean like kind, for investment property for investment property.
So you couldn't do, like, commercial property for farm ground, or could you?
You invest.
You could. When you're dealing with ground, there's another question you have to get into. You know, are you buying it? The other thing that a lot of people think about, or a lot of people don't understand, you also can't be buying investment property with the idea to sell it. That doesn't count as an investment. So like if you're a flipper, quote unquote flipper, 1031s won't work for you. Because you're buying the house with the intent to rehab and resell. That does not count 1031. That's not an investment grade.
What? Why isn't that an investment? 'Cause you're.
It's not an investment. It's a job. You have got to be holding it theoretically for an investment.
So flippers always have to pay that capital gain?
Yes, flippers will always pay ordinary income. That's why I said with the land, it kind of depends what you're going to do with the land.
So what about if you're a flipper and you did it in less than or you kept it for more than a year? Right now you said currently it's 15%.
You just pay 15%.
And then what if it was the short-term capital gain?
Means you flipped it in a year. You wanted your money out.
Yeah.
It would be treated like ordinary income.
So okay. I just want to make sure I understand that. 15%.
Yeah.
It's treated like
But if you bought the property with the intent to resell, it's not investment grade by IRS. It is a job or activity. I have to buy the rental property with the intent to rent it out and sell it and lease it. And 4 or 5 years down the road, when I want to go to sell it, I say, well, it's been a rental property for 4 or 5 years. I want to 1031 it into another rental property. So developers can't 1031 land because they're buying the land with the intent of building a house and reselling it. That's why I asked you when you said land, it's kind of tricky on that one. So you have to invent like-kind property. Now, to be completely tax deferred, it's not tax free, it's tax deferred, I have to do what's called going sideways or up. What I mean by that is I've got $40,000 in capital gains. I've got to use all $40,000 or more on my next property to it could be 100%. If I bought a $30,000 double or traded for a $30,000 value, I would still owe 10 grand in taxes. I would still owe the taxes on that 10 grand because I only used 30 of the 40. Everybody see what I'm saying? If I went out and bought Greenwood's Mall for $40 million, I definitely went up.
So if you're going down, you can plan on paying taxes on the.
Yeah,
on
you
the
will pay
difference.
taxes.
Yeah, but if you're going sideways or up, then you're good.
You're good. Yeah, it's called going down and out. If you're going down and out, you're paying taxes. Like you're selling, you want to liquidate your portfolio because you're old and you want to retire. You're going down and out, you're going to pay. So now here's what happens with your 1031. You don't pay the taxes on this 40 grand. You just trade for the next property and you go to the $40,000 and you trade again for the next $40 million, then you go up to this next $400 million mall, and you paid no taxes because you've 1031'd all the money out. All right? But Uncle Sam is not going to let you get away with that. As part of the 1031, you are going to bring your original basis with you. So what, in this example, I'm now up to a $400 million mall. What's my original basis?
50 or 60.
Still back to 60 grand. So now if I sold the property, my profit is $399,940,000 that I would pay taxes on. Because now all those taxes that I didn't pay are now catching up to me when I go to sell it. So I avoided, that's why it's called a tax deferred exchange.
That eventually catches up.
Because it will catch up to you. Now, with that being said, there is a way to get out of paying taxes on that. Paperwork's real simple. You know how to do it?
Move to the Cayman Islands.
Die.
Oh.
Yeah.
Said move to the Cayman Islands.
When you die, your kids inherit them all. They get what's called a stepped up basis, so they move it to current value.
And they get to pay inheritance tax.
That's where inheritance tax comes in. Because now their $400 million rental that my kids inherited from me, they get a basis of not $60,000 anymore. It steps up to market value of $400 million. So there's actually zero capital gains when they sell it. We're at 400, their basis is 400. Zero capital gains. But to inherit that $400 million property, there's an inheritance tax on it. That's where the inheritance tax comes from.
How much is that?
It's a lot.
It moves.
It
It's
was
moved.
11%.
Yeah. Every year there's a different schedule. I don't have the
Yeah.
slightest idea what it is this year.
It's ridiculous.
And what's even more about it being ridiculous is the inheritance tax doesn't matter if you keep it or sell it.
You still have to pay
You
it?
still pay it.
Really?
Unlike, I would only pay the taxes on that $399 million if I sold it. So the capital gains tax is only paid on a taxable transaction like sale, whereas inheritance tax doesn't matter. And remember, we talked about that a long time ago when we talked about the specific general lien or the specific involuntary lien was inheritance tax. This tax goes on everything until you pay it. I've been involved in a couple of sales for clients where the property they inherited, they couldn't afford the tax on, and the only way to pay the tax was to sell the property they had to pay the tax on. It's kind of like the old, you guys are,
You gotta have money to make
I'm
money.
going to dread saying this. Remember the old Henry poem? Or the story where the guy bought his wife the comb?
She cut her hair.
She sold her hair, bought him a watch fob, and he sold the fob to buy her the comb? Seriously.
No.
Sure,
Don't remember
you're
this.
right.
I know I'm right.
Happy birthday.
You guys don't remember that? Have we ever remember
She's
that?
just trying
I think you're so
Remember,
yes,
she
I
was real
remember.
pretty and had the long hair, and he had this really great pocket watch. And at Christmas time, they didn't know what to do, so he sold the pocket watch to buy her a really pearl-handled comb for her hair.
Okay.
And she had cut all her hair off and sold it to buy him a watch fob to hold on his watch. So
Yeah.
it's called the gift of the Magi.
Nope,
Yeah.
never heard that one.
I do
They used to show
remember.
that on
Damn, it's
TV
tough
at
being a
Christmas.
I need another analogy.
Damn, it's tough being
I
a
don't know.
genius and knowing everything.
Yes, dear.
Okay.
I know it.
Come on.
Thank you, Leslie.
Go down.
Thanks. So I didn't dream it, right?
No, they used to show it every year on TV.
Yeah.
Right around Christmas time.
Yeah, because it's a
Yeah.
tug of the heart story. They sandwich it in between It's a Wonderful Life and It's a Wonderful Life, which they show nonstop.
With a Christmas story.
Now, one other thing I do want to talk about real quickly. Sometimes if I've got like a $40,000 double and you've got a $50,000 double, we can kind of agree that those are equal, but I may give you something in addition to my 40,000. Say, I'll trade you my 40 for your 50 and I'll give you a diamond ring. Okay, that diamond ring is called boot. Anything I would add to the deal to balance it out, could be cash, could be personal property, could be whatever, is called boot, B-O-O-T.
Yes.
Friends booty.
430. Like
Boot
just
balances
kick-
that
kick it down.
exchange.
Okay.
I'll give you this 10,000, and I've also got a strip of land that's really not worth anything downtown. I'll throw that in as to balance the deal. Okay, that would be boot.
And you're paying tax on that.
Yes. See, I think here's that example for my tax basis. 50 grand, I put a new roof in. That's a true story, by the way. Had 60 into it. I sold it for 100. I paid taxes on the 40,000. Don't forget all the other deductions. Also, make sure that you get if you're an investing property. So, like, I'm cleaning windows. I want to buy a window cleaner to clean the windows in my investment property. That's a deduction. I don't know if I really want to get into the fact of active income versus passive income, because now the new tax rules are you can only subtract passive losses with passive income. So if you hire a property manager, like Randeep has hired me, the income he's generating is passive income. It's not active because he's not doing the work. Whereas you own rental property and you manage your own, that would be active income, which is like 400 hours a year, something like that. Defines it 15 hours a week, 750 hours a year is what IRS says is active income. So you can't write active losses off against passive income anymore. That was the old doctors trying to do the tax shelter where they go out and make so much money, so they'll buy a property that's losing money so they can write it off. You can't write off active. It has to be passive versus passive. Now there are other couple of things I want to talk about real quickly. This first one is called a real estate investment syndicate. This is where a bunch of people get together and put money in a pool and create a syndicate. This is theoretically where the TIC comes from. You know, we talked about tenants in common before, and we all said they all own it. They all have different proportional shares. They all have different title. How did they get there? They got there through this method. You know, I can't afford $1 million property, but I could afford maybe 300 grand. So we'll call Tracy, and she's like, well, I'll put 50 in. Okay, so I got 6-1 for her. And Christine says, I'll put in something. And we all create a TIC, but it's actually a real estate investments syndicate. Then you've got these things called a REIT, a real estate investment trust. The biggest one in the world that we know with malls is who? Simon, right here in Indianapolis. Watch this. Suppose you want to invest in property. You're going to go out, spend 100 grand buying a rental property. At the end of the year, you've collected $8,000 in rent. What kind of return is that on your money? I'll help you out real quick. That's 8%.
Yeah.
All right. And where I told you one of the disadvantages was the high cost of entry. Well, I don't really have 100 grand. So here's what I'll do. I'll go out and buy Simon, a share of Simon stock, and he's paying 8% return. So now I can put $100 down, make my $8 at the end of the year, and guess what? It's still 8% return. That's what an investment trust does. I don't want to manage it. I don't know how to manage it. I don't have enough money to do it on my own. So what I'm going to do is give it to someone who does. And I bet damn well know that Simon knows how to manage them all. So what I'm going to do is I'll give him $100. And then everybody in the United States gives him $100. And he takes that $12 million and goes and buys a new mall. And then he can return 8% to us. How can he guarantee an 8% return? Think back a couple of days ago. Because the tenant is paying all of his bills, right? That's what I told you that. That's where this comes in. Simon can say, give me $100, I'll pay you 8%. Okay, well, once the taxes go up, my profit goes down? No, because the tenant's paying. It's a triple net lease. Everybody in my mall is paying a triple net lease. Macy's and the Sporting Good and Don Pablo's and whoever. So if taxes go up, insurance goes up, doesn't affect you a bit. We're still making our $8,000 a year because it's triple net. And there are some rules for the REIT. They have to distribute like 95% of all their income. So think of all the money that Simon's got and realize that's only 5% of what they're making, because 95% has to go back out. That's
90,
one of,
90.
huh?
Says 90.
Does it say 90?
That's what it says.
95 there.
I said 95 on the screen.
You did.
What's the book say?
90.
Really? Because my book on page 431 says 95.
My book says 90.
Mine says 90.
A real estate investment trust does not have to pay corporate income tax as long as.
A real estate investment, yeah, as long as it,
90% of its income is distributed to its shareholders. Yeah.
What version do you have?
Soccer.
The 19th still?
I still got the 19. Mine says 95%, her book says 90.
You're
Mine says
right.
90.
It's 95% is the answer.
Okay. You're right.
I know I'm.
You're writing names.
He's writing the test, right 95.
95%.
So if I fail the third test, you get it.
Mutual fund works, a REIT is just like a mutual fund, basically.
Okay.
Mutual fund, you guys know what a mutual fund is? I buy into a group and they own a bunch of different stocks. And if each one does good, then I make the money. Same thing with the REIT. I buy into Simon, he's got a bunch of different malls. Mall of America, Caesars Mall, Greenwood Mall, all of those. So it works just like a mutual fund.
So in essence, to only be having 5% of the income distributed to you, Simon, I mean, you're talking about a lot of money here.
Yes, that's what I'm talking about.
Yeah.
Billions of dollars a year.
Yeah.
You ever seen his house on the north side?
Yeah. You know what? He still died.
Exactly.
Doesn't matter how much he's worth. Still cashes out in the end. Then there's one other thing that's very similar to this. It's called a REMIC. It's a real estate mortgage investment conduit. Basically what it is now, you guys become the jet clampets. So instead of loaning directly to the buyer of the real estate like Simon would, we loan money to the lender and they lend the money to Simon at an interest rate, and then that interest rate flows through back to us. So you're giving the bank money. That's the easiest way to think of it. You become the Jed Clampett of the world, and I told you that banks don't have money.
This is how banks work anyway.
Yes, this is where it comes from, all right? IndyMac Bank was one of these. Washington Mutual was one of these. Both of those are gone, by the way. Happened with that too big to fail thing. But theoretically, you could buy shares of the mortgage company. They would use that money to fund loans, and those loans would then pay an interest rate. That interest rate would flow back to the investor. So you're the Jed Clampett. All right, 22 chapters. A couple of things I want to talk about real quick before we end.
You missed 21.
Please like our Facebook, facebook.com/realuniversity. I want to thank you all for your attendance and wish you good luck on the state exam. If you have any questions, feel free to get a hold of me. You can do that, all right?